with this guy. So welcome to this week. And Pete, if you want to do a very quick intro, I can, well, let me put up my screen of this. And there is our today's slide. And I will go back and let these people in that have come into the waiting room. And participants, anyone? Oh, whoever was there apparently left. Odd, okay. Anyway, welcome to week 4 of It's Your Money. And this week is the second part of financial planning with investing your money. And Gina is back doing those. Basically, this is the straight intro as we have done in the past. I need to figure out how to make this guy go forward on me. There, okay. So we've got him muted and video off so you go ahead with the recording. If you want to change any of the scenery to this, of background or gallery versus speaker, you can go up to the upper right, change those. As we said before, if you want to give us a chat, because I'm monitoring those, type in whatever you want, hit enter, and I will read those during the class. The website for It's Your Money and Estate.org is the website that we have. When you go in there, you can look under sessions, It's Your Money, and then select which week you want. You may need to scroll up or down or around to be able to find that information. Let me bring in this person. We're not sure whether it's going to be at the top or the bottom, but if you go there, there are now videos for week 1, 2, and 3 that are posted there, as well as the handout material. So depending on where it winds up being oriented, it should be at the top, but it may be somewhere else. So I just want to give you that information because they're YouTube videos and you're very welcome to, love to have you look at them and send us some comments or give us some input. So we're on week 4, as I said at the moment. We're doing investing your money. Following that, we will then, next week we do caregiving and insurance and long-term care. So that's where we're going with this. So Gina, I'm going to stop sharing and I'm going to have you go ahead and bring up yours. And I will keep admitting people over here. And then you're in control.
Great. I feel in control.
There you are.
Isn't that your motto? Feel in control?
That's it.
Yeah. Okay.
We had that as a website, Gina, and most people thought it was a psychological website. So they went there for counseling.
And got you?
How did that work?
It didn't work well.
Yeah.
Welcome back, Gina.
Thank you. Thanks for having me. It's always a pleasure. So we're on part 2 of financial planning. And last week we talked about who I was, what a CPA PFS is, that credential. And I understand that there's been a new recording posted on the website that will explain further what that is. But just to go back, and for those of you who weren't there or who missed the recording, fiduciary fee only and all good things. And so last week we talked about how to figure out your financial goals and what they might be, and the process you could go through to help you sort out what's really most important and prioritize your goals. And then how to build your balance sheet and the easiest way to come up with what your spending needs might be going forward. And we left you with a cliffhanger on how to understand and assess your risk tolerance. So we're going to talk about that today, along with what follows, which is your determining your asset allocation. I'll define what that means, selecting the specific investments that fall into those asset allocation classes, and then how to rebalance your portfolio and when to rebalance your portfolio. So the question I think on most everyone's mind is, why should I take risk with my investments? And a common dilemma that we hear from our clients and prospective clients is, I don't want to take any risk. I don't want to endanger what I have. I want to keep what I've got. But of course, I want to make money. So there's this disconnect for most people between risk and return. And what I hope to show you is that with a well-designed portfolio, the two are very much related. So you want to be sure you're designing your portfolio for the level of risk that you can afford to take and for the amount of return that you need to have in your portfolio in order to be successful.
The way I usually describe that, Gina, is that individual professionals such as yourself try to find a sweet spot on the tennis racket to get that ball over to the other side in the right amount of speed and velocity and where you want it to go. It's not just about the return. It's that, you know, what is the least amount of risk with the maximum return?
Exactly. Yeah. And I heard a great example along those lines yesterday. For those of you who've seen the movie Ford versus Ferrari, where they talk, and it becomes very obvious that all these minute components work together to make those cars do what they do. And, you know, the car can't go fast if any one of those things breaks down. So there are a lot of components to building a fast car, an efficient car, and the same thing is true for building an investment portfolio. But risk isn't just about volatility, which is kind of what we're talking about with the investment portfolio. It's also about inflation. So if you do nothing and put your money under the mattress, we know that 10 years from now, you know, we won't be able to buy as much with that money as we are able to buy today. But the other reasons, and it kind of wrapped up into that, is to make sure that your assets are there, that you don't run out of money before the end of your life, and that if you have legacy intent or charitable intent, as many of us do, that that you have the money left over that you want to give away. So here are the big questions. Usually when people think of risk tolerance with regard to their investment portfolio, they're thinking about their willingness. How do I feel about this? So, you know, risk is really that, you know what it is, because we've all been, unless you live under a rock, we've all been exposed to a lot of it lately. And with the markets dropping, you know, having their single biggest drop in history in one day, that's very frightening. It's scary to think, oh my gosh, I worked a lifetime for this money, I've invested it, and now it's declined in value by so much and it may never come back in value. So I think that's really a component of the willingness to take risk. How do you as an individual feel emotionally about your money and about your portfolio? And it's easier for some people to accept that it's a temporary decline in value than it is for others. But you also want to think about your ability to take risk, which is, you know, if you're for a very young person and you're not going to need that money for 40 or 50 years, you have a very high ability to take risk. But if you're older and you're spending the money today, then that may not be the case. Your time frame is very short.
So time horizon is just absolutely important.
Exactly. And then really, do you need to take risk? If you've got enough and you know you're going to have enough to meet your own needs and you know, any legacy intent, then do you really need to take risk? And then that kind of goes back to the willingness. So, you know, how comfortable is it for you?
You know, in that particular question, I find that most individuals have problems with that because money means security. Can you ever have enough security?
No.
You know, it's just, you know, so that goes back to your spending plan. What are you spending on an annual basis?
Right. Yeah.
It all works together.
Well, and that's funny when people ask me, when can I retire? I always say, well, you can retire now. It's a function of how much you want to spend in retirement. Yeah. So for everyone, that's a different answer. But here's a questionnaire that we utilize when we manage 401k plans, which we do. We always, it's very hard to do risk tolerance for a large group of individuals. So we ask them to go through this questionnaire. And I won't bore you with the details, but basically, if you ask yourself these questions, you can kind of rate yourself from on a scale of 1 to 10, and then add up the scores for the answer to each question. And that'll tell you kind of, give you a rough idea of the amount of risk that you can tolerate or should be willing to tolerate in your portfolio. So if your willingness is a 1, but your ability and your need are a 10, you've got some thinking to do, because you're now, maybe in a situation where you need to take risk, but it's going to be hard for you to stomach it.
Yeah, and Gina, and isn't that's why to know what the historical returns are for different asset classes becomes so important?
Absolutely. Yeah, we're definitely going to go through that. So I want to segue into, once you've established what your risk tolerance is, let's say you're a moderate, a 12 to 20. That means what that refers to is the allocation of assets in your portfolio. And when we talk about asset allocation, we're really talking about the percentage of stocks and the percentage of bonds that are in your portfolio. And we know historically that a huge percentage of performance or the returns in any portfolio, in any investment portfolio, is determined by the allocation to stocks versus bonds. And what's even more interesting is that I find so few people actually understand what the difference is between a stock and a bond. So I'm going to explain that. For those of you who are more sophisticated investors, I apologize, but I think it's really important to understand kind of what these animals look like. So if you looked at every investment in the entire world, you could pretty much categorize it into one of these buckets, either a stock, it acts like a stock, or it acts like a bond. And there, of course, are some, some small differentiations in between, but this is what most people are investing in today. So with a bond, it's a loan. Think about if you have 2 friends and one is asking to borrow money from you, and they've always been very good with their money, and it's an emergency situation. You're confident they're going to pay you back, and they only need the money for a short period of time. Versus the other friend who's borrowed money before, never paid it back, and says they'll pay the money back in 5 years. And using these examples so that you can understand the risks involved in bonds. So the amount of time that the loan is for and the credit quality of the person or company that you're loaning money to are the 2 major factors you want to consider in any bond investment.
Just so for the audience members, for the attendees, just so you know, we're going to spend an hour and a half on the bond area, and we're going to spend an hour and a half on the stock area. And what Gina is doing right now is giving you an overview, because you really need to understand your asset allocation. It's kind of like your birth date, your tax bracket, your net worth. Asset allocation is right up there, and this is a perfect example of the different types of assets there are in the world.
Yep. So I think for most people, if you have friend 1 and friend 2, remember friend 1 is the one who wants to borrow the money for a short period of time. They have great credit rating. They're really, really sturdy. You're going to prefer to loan money to that friend. And that's sort of the equivalent of like a treasury bond or a CD, both of which are considered bonds. So CDs Treasury bills, treasury bonds, corporate bonds, junk bonds. Those are all in that bond category, and they're pretty much differentiated by the length of time to repayment and the credit quality of the person or entity that you're lending money to. Stocks, on the other hand, you're making an investment in a company. You're giving money to someone. Let's say your niece wants to set up a lemonade stand down the street, and she says, "Mom or Grandma or Grandpa, can I borrow $10 from you? I'm going to go buy all the lemonade and the cookies, and I'm going to do this, and hopefully I'll make money and I'll get to pay you back." And you say, I'm making an investment in your lemonade business, so I'll give you 10, but I'm hoping that, I'll get a percentage of your profits as well. If you make $20, I'm going to get like $11 back. And the niece or nephew says, "Well, I'll do my best." And, if they're good and they have great lemonade, then yeah, they pay you back the $10, or maybe you hang on to it and they grow the lemonade stand so they don't pay you back. But at some point, they're paying you dividends or a percentage of their profits. So we have
an owner or a lender, huh?
Exactly. So stock is an ownership interest. Bond is a loan. And the major risk difference here is that with a stock, in most cases, you're taking the risk that you may never get your investment back. With a bond, in theory, you are guaranteed to get your money back. There's a promise to repay you with interest. So when we think about stocks and bonds for different companies, we want to know, well, what's a good framework for evaluating which companies, stocks, and bonds I want to invest in? And we want to think about what's the risk in each case and what's the return, right? So on the stock side, more risk, more return. On the bond side, less risk, less return. So on the stock side, and this is a pretty confusing, these are pretty confusing concepts here. I'll walk through them one by one. But basically what you're compensated for when you buy a stock is the equity, what we call the equity premium, which is that risk that you may never get your money back. There's no promise to repay you. But what we find, there's a great deal of financial research out there in the marketplace. And so our firm, Clarity, does what we call evidence-based investing. And it's we only invest in investments that have a great deal of data and economic information about them. But we actually are looking for these qualities. It's not a matter of what industry they're in. It's not a matter of how much dividends they pay. It's a function of the size of the company, the relative price of the company, meaning is the price of that company's stock relative to its book value high or low?
Do you, as a company, Gina, do you invest in individual stocks, or do you invest in indexed or mutual funds, or do you do both?
We don't buy individual stocks, and so I'm speaking euphemistically here, but because we only use ETFs and mutual funds, which are baskets of stocks. So I don't want to mislead anyone into thinking that we're actually analyzing each company, but the money managers who manage those funds and those ETFs are looking at these characteristics, and those are the managers that we're selecting.
Let's go to the next slide.
Okay, so just to emphasize too that the primary determinants of return in bonds or fixed income, which is another way of describing bonds, they're the same thing, are the term of the loan and the credit quality of the lendee. So this is a lot of information here, but I just want to focus on the premiums here. When you look at stocks, why we're choosing the smaller, so the smaller companies tend to generate about 2% a year more premium, at least historically.
Before you go through that, Gina, could you talk a little bit about the different categories of stocks that, like, say, Morningstar uses? You use some of the terminology is on your slide.
Yeah.
Small, big, medium, but why are those things? Why are the definition of those things important for an individual?
They're important. So there's been a ton of research done about all the different characteristics of companies and which ones will ultimately result in a higher rate of return if you invest in that company's stock. So what all the research indicates is that smaller companies relative to large tend to return more profits and pay their shareholders more in terms of their share value over time than large companies.
And yet, when you invest in the small companies, the volatility is greater and the risk is greater.
Exactly. So we know risk and return are related. So the price of those small companies tends to move around a great deal more than the price of the large companies.
So give us an example of what a large company stock would be.
Well, like the FANG stocks, which everyone's heard of, Facebook, Apple, Netflix, Google,
Amazon.
those are huge companies. Yep. And, the smaller company stocks are going to be things like Clorox. They're probably big by now, but who knows? But right now, especially.
Yeah.
But
Zoom, what we're on, was probably a small cap stock, maybe a month ago.
Yeah. So when you hear people talk about small cap stocks, this is what they're referring to. And these are all publicly traded company stocks. These are not private investments. These are all publicly traded. You could buy any one of these companies individually on one of the public exchanges.
So basically there's three major types. There's the large cap, mid cap, and the small cap.
Yep.
Now, what is in the chart here, you also have the terminology called value and growth. What does that mean? And does that apply to each category?
It does. So these premiums are pervasive across the globe, around, in pretty much any marketplace. We find this to be true, that companies whose stock price relative to their assets or their balance sheet, and we know what a balance sheet looks like because we did one last week. But if for a company, if you say, okay, they've got, this company has $100 in cash on their balance sheet, and that's it. And their stock price is $100. Seems kind of cheap, right? And you might have another company that has $100 on their balance sheet and their stock price is $200. So you think, well, what does the market know that I don't? Obviously, the market is expecting that the company with the higher price is going to have higher, better income prospects going forward. So what we find is that these relative prices, what we call value stocks, just think of them as like bargains. Value equals bargain, a bargain stock, tend to outperform the stocks that whose have a higher market price relative to their book value.
So Zoom, for example, since we're on the Zoom, would that be considered a value stock or would that be considered a growth stock?
I don't know.
I would guess as a growth stock because they're not paying any dividends. They're fairly new. They're still, multiplying.
Yeah, I don't know enough about the stock to comment. Yeah. But in general, that's true. Growth stocks tend to be older companies, but not always. It just depends.
but they behave differently. And so as a category.
Mm-hmm.
And so,
Yeah.
and it's important, I think, for people to understand what they have in their own portfolio at the present time. And so they're broken up into large cap. You should know your percentage of large cap value, of large cap growth, of mid cap value, mid cap growth, and small cap value and growth. And then we have additional ones as well. But, you know, most people don't know what they own.
True. And along those lines, most people think of the market being the S&P 500 or the Dow or the NASDAQ. I mean,
What would you consider the S&P 500 to be if you had to describe it with this kind of terminology?
It's large blend, but it's mostly large growth.
Okay.
Mostly large growth. And most of the portfolios I see that come to us from warehouses or brokerage firms or whatever, the clients are predominantly invested in the S&P 500 because most people that's what they're using to benchmark the returns in their portfolio. But each of these groups of stocks are going to behave very differently. There are almost 4,000 stocks in the U.S. marketplace. So if all you own is the S&P 500, you probably don't own much of these value or small cap stocks.
That brings up with the terminology diversification. What does that mean?
Well, it means, you know, don't put all your eggs in one basket. You know, if you're completely invested, if your entire equity portfolio is invested in the top 500 companies in the U.S., that sounds safe, but there have been many periods in history where that part of the market underperformed the rest of the market. And we'll look at that in just a minute. I'll give you some examples. The third premium that we find is pervasive, and this one's very logical, it's profitability. Is that the companies that have higher profitability tend to do well and exhibit higher returns than those with low profitability. So when you're hiring a money manager or looking for a mutual fund manager, you want to make sure that they're focused on these three premiums, because this is the best way, the most intelligent way to invest in a diversified portfolio.
Well, we've talked about large cap, mid cap, small cap. We haven't talked about international, emerging, and developed. And you have them on the you had them on the slide there. Why are they important? And should we think of investments as good or bad, or how should we think of our portfolio? And talk a little bit about the emerging and international.
I'm gonna go through diversification here in just a minute.
Pete, I'm going to make a point that we spent an hour and a half on these, so we might want to move forward because this is an intro to it and not in detail of it. So we might need to move on through it, and rather than staying in, because we're going to do an hour and a half on each of these. So
okay, that's a good idea. Thank you, Don.
Yeah, so this is probably too much detail for most people, but just a kind of a teaser to be thinking about, you know, how these different factors work in these different marketplaces. And then when we look at the fixed income marketplace, remember fixed income means bonds, which includes CDs, treasury bills, treasury bonds, corporate bonds, and junk bonds, along with a lot of other weird bonds, municipal bonds, state bonds. Those are all in this fixed income category. So the purpose of fixed income or bonds is to stabilize the portfolio. And what we saw recently in March when the market tanked was that, at least in our clients' portfolios, their bond holdings went up significantly in value at the same time that the stocks went down in value, which is wonderful. And I'll show you some interesting numbers here in just a minute to support that. But our portfolios behaved as we expected them to, and we're hoping they would behave in this type of market. And when you're looking at bond funds, you want to be careful that whoever's putting the fund together, or if you're buying CDs or treasuries, that you're not that they're not getting marked up. And it's a very easy way for the average non-fiduciary broker to make a lot of money. They put a 2% markup on a bond, and you have no idea. You don't realize it.
Yeah, the bond market is about, I would say, maybe 1,000 times bigger than the securities market. So there are many more bonds out there than there are stocks.
Yeah, as a general rule, we keep our bond portfolios very high quality, only A or AAA rated bonds in the A category, and relatively short term.
Yeah,
so,
we're going to go through that in the bond area, but remember, the bond portfolio acts as a balance to your securities portfolio. And just like Gina said, her client's portfolio didn't drop nearly as much as if you just had a straight securities portfolio. It acts as a balance, and it also acts as income. So let's go to the next slide.
So all of these concepts are wrapped up in what we base our investing approach on, which is modern portfolio theory, supported by tons of academic research and evidence. University of Chicago are a leader in this area if you have an interest in reading about it. And one of the most important concepts there is that markets are efficient. Markets work. So when information is distributed, the markets adjust literally within, less than a second. I mean, all around the world, new information is incorporated so rapidly that trying to pick mispriced stocks or trying to time the markets is really a fool's errand. And that's a huge concept that I'm gonna go into in more detail here in a second. We've already talked about risk and return. Risk and return are related. I like to think of them as brother and sister. And diversification is key. As we talked about with stocks and bonds, if you offset your more risky assets with more conservative assets, then when the market behaves badly, those bonds are going to keep your total portfolio value in line.
The number one question I've always received during these workshop series is this a good investment? And a good investment is a diversified portfolio. There is no good, bad. Well, there are bad investments, and we're not going to talk about that. But
there are some bad investments out there.
But a diversified portfolio is what you're looking for.
A diversified, yes, and as well as low cost, liquid. I mean, there are a lot of things that go into that. But yeah, diversification is what we call the only free lunch in investing. So here's what I was talking about earlier with the S&P 500. If that's all you have on the equity side of your portfolio, then you've got 500 stocks from one country. And if you have a globally diversified equity portfolio, you're invested in 46 countries with over 8,000 stocks. So that makes more sense, and you tend to diversify away a lot of risk when you do this.
I love this chart.
Yeah, the Skittles chart. I'll let you just focus on this for just a second. Just meditate on it. See if you can find a pattern. So each one of these little squares represents a part of the market with, and you can see the colors down below. We're looking at the S&P 500. We're looking at the Russell 2000, which is a broader
index.
2,000 stocks, broader index with more of those small and value companies in there. The Dow Jones REIT, or real estate index. We have the international small cap in yellow. We have emerging markets in that aqua blue.
What is emerging markets? You didn't define those.
Sorry, yeah. So internationally, we tend to divide assets into international developed markets, which would be countries like the European Union, Britain, Sweden, all those types of companies, Japan. And then you've got emerging markets where there are, they're either third world countries or their markets are not as robust as they could be. China is a good example.
Vietnam.
Where they don't allow, it's a huge economy, but they don't allow non-Chinese investors to buy on their markets. There's a whole A-shares market, it's a whole different market that you have to deal with there. But so they're kind of lumped into this emerging markets, which would be primarily India, China, Brazil, companies like that, where their governments aren't as stable. Maybe they don't have free information. It's a little more risky.
So really the key to this particular chart is you can't pick a segment and fall in love with it and hope to win every time, because it changes every year, and that's the key to it. And so from that standpoint, I would move forward. Yeah.
So that's the point, is it's random. And while you would think that the S&P 500 was at the top, it's actually, you can see it's only on the top line one time since 2005. And for a long time before that, that was the case as well. So diversifying across all of these groups of investments makes a lot of sense. So here are, I'm going to use as an example, these are our 401k model portfolios, or one set of model portfolios that we use. And they're divided, so our 401k participants can choose from each one of these very diversified portfolios depending on how much risk they're willing to take on. So the highly aggressive, as is appropriately named, it's 100% in stocks. And they are diversified across the US and globally, and all the way down into the risk averse, which is only 20% in stocks and 80% in bonds.
So what each attendee needs to do, I think, is besides knowing your net worth, your spending plan, what's your asset allocation? Where are you in this chart? And
that questionnaire earlier, I think, will help guide people to considering, how much risk they need to take on in terms of stock.
And each one of these has a different expectations of a return, not in any one year, but over a period of 3 to 5 years, I'm assuming.
Exactly, yeah. So here's just a quick look at what's in these portfolios. And we have the same investments in each portfolio, but just in different amounts. And this is where I just threw this in so you could see on a cost basis what you should be looking for in these individual mutual funds that you may or may not be investing in. But and I just shown this relative to what's out there. The category average expenses are very high. So you want to look for relatively low cost mutual funds in order to fulfill your in specific investment selection.
Yeah, you need to understand the expenses and the fees that you're paying presently on your portfolio. And it's not easy. Morgan Stanley just came out in the news day before yesterday that they got fined by the SEC $5 million for not explaining their wrap account fees.
Yeah,
it's just very difficult. The average broker charges in their retirement accounts an average of 3% per year. That is just huge. And you should be looking at a Vanguard or a dimensional funds, which is only, dimensional funds is only available through advisors such as Gina, but you look at funds that are low cost, and low cost funds are more than likely quality oriented, better for you, and give you a greater return.
Yeah. So what I want to show here, and these numbers I think are very interesting because they're pretty scary, but these are as of March 31st. So one of the worst periods for the stock market in a very long time. You know, really record-breaking.
I'm sorry, this is year-to-date 2020? Through March?
March 31st.
Through March 31st, right. But it's year-to-date.
From January 1st to March 31st.
The first column there is year-to-date returns. So in our 100% equity portfolio, in this example, lost 26, almost 27% the first quarter of the year.
But in that highly aggressive, after 10 years, it's up only 5%?
Right, but I would say, so I threw this in here for two reasons. One, to show you that risk and return are related. So even though we've just come through one of the absolute worst market periods in history, there's still a positive return of 5% over the last 10 years.
That's 5% annually, or 5%
per year, 5% per year. Yep. Okay. Even in a horrible, horrible environment. And these numbers have come way back up since March 31. But I just wanted to show this to show what a beautiful thing the market is and how well it works. So you can see.
For your clients, do you give them a quarterly report where you show them what the year-to-date return is?
Oh, yeah.
But brokers don't.
No. In fact, we give them cumulative returns because we're very proud of it. So we show these type of numbers on every client statement every quarter. So if they've been with us for 10 years, they know exactly after fees how much they've earned on their money in total.
Most brokerage statements just tell you what the value was at the beginning of the year and what the value is now, but they don't consider withdrawals or additions, or they just give you a number.
Right, that's very true.
And these are returns on mutual funds after fees, not stocks.
After the mutual funds internal fees, right? Okay. So, so what you can see is that in the highly aggressive there, over 10 years, 5% rate of return. Not that great, but you know, it'll change. I mean, as of last year, this time, that number was double that number. So it'll change, but I'm using this because it was a terrible period to show you how much risk and return move in lockstep. So, and you go down and as you've reduced your allocation to equity securities, you can see that portfolio with only 20% in stocks declined by only 5.5% during the worst quarter in stock market history. So that's not terrible. And over 10 years, it earned 2.43%,
and yet this is not what you see on the news. This is not, you know, because the stock market just had their worst year and period. You think the whole world is coming to an end. Losing 5% or thereabouts, it's not that great of loss.
Our clients we've been talking with a lot of clients. We send our quarterly reports out in April, and so have had a lot of those conversations, and people are very pleasantly surprised. They're like, yeah, you know, it's not great. I mean, would we have liked to have earned more than 2.5% over the last 10 years? Sure. But we understand this is temporary, and this will more than likely get better. So
your asset allocation drives your return.
Yes, exactly. So looking at that risk aversion, if you're risk averse, fine, you can protect your portfolio, but it comes at a cost. And if you feel comfortable that you can withstand a 26% decline because you're not going to need to spend that money for the next 10 years, And I'll show you some more data coming up on how quickly markets do recover from crises like we've seen recently. And I wanted to point out too that Vanguard has an option called the Lifestrategy funds, which are balanced, very diverse portfolios, balanced portfolios of stocks and bonds. I don't remember what the exact expense ratios are.
They're about
for
50
Vanguard.
about 50 basis points.
Yeah, it's
half of
in there.
1%, between
Yeah.
35 and 50 basis points.
But they're building the portfolio for you. And they do a nice job. And you can take a little quiz there if you go to Vanguard and just look for Lifestrategy funds. And I will often point young investors in this direction because it's a reasonable fee to pay. The fund expense ratios are relatively low. Oh, just throwing this out at this point, I could figure out where else to put it, but not only do you want to consider the individual securities, but you want to consider where you house each of those mutual funds. If you have IRAs and trust accounts and Roth IRAs, you want to make sure that you're paying attention to the tax management of your investments and putting them into the right account. It can
And you
dramatically.
mean by, you know, if you have an IRA account, if you have a high dividend, taxable dividend, you may want to have it in your IRA account because your IRA account doesn't pay any taxes until
Right.
until you
take it
withdraw.
out.
Yeah.
Yeah.
So asset location is pretty important. Now, should you
Asset
consider?
location.
Yeah. Should you consider each asset location, what you have in your IRA account and what you have in your regular investment account? Should you look at those differently, or do you combine them for your asset allocation purposes?
We encourage clients to look at the total return of their portfolio. So not by account, because it's very inefficient to have an entire portfolio modeled out in each account. You're going to pay a lot more in trading costs, and taxes aren't going to be minimized. So it's best to say, house the investments that you want to defer taxes on in the IRA, and those that are throwing off capital gain, for example, in your trust account or your regular individual account.
Yeah. So it's important, if you have an account with a fee-only fiduciary advisor, to let them know of your other accounts, because it would be very difficult to manage your one account if they don't know your entire financial history.
Very
And
true.
you had an example for Vanguard, but it could also be Fidelity or Schwab or other firms that have lifestyle type, life history, lifestyle, in terms of where you are and, you know, are you near or away from retirement? And that's, so it isn't just Vanguard, there are other firms also.
Not just
Yeah,
Vanguard,
I'm going to make a point on that, Gina, because Fidelity, Schwab, TD Ameritrade, there are custodians. However, they also sell stuff. At least Vanguard there are no products with Vanguard that you can purchase on commission. With Fidelity, you can. With Schwab, you can. And TD Ameritrade and Schwab are coming together. So if you're going to pick out a mutual fund, and I'm not being paid by Vanguard or anything, I don't get any kind of referral fees. If you're going to go with
either.
Yeah, if you're going to go with a
think
mutual
they're good.
fund, I highly recommend Vanguard.
Yeah. Their fund fees are pretty low. So, so to that point, total return is important, and asset location is a big factor in that. But you also want to look at a common broker pitch is buy dividend stocks, buy them for the income stream, and that strategy is flawed in many ways. Not the least of which is that it's very tax inefficient, because now you get dividends whether you want them or not. And if you have two companies that have very similar characteristics, one pays dividends and the other one doesn't, the company that doesn't pay dividends is going to have a higher stock price. So you then have a choice, if you need money, of selling that stock, reaping a capital gain, or being forced into accepting dividends, which might be taxed at ordinary income rates on a regular basis.
Yeah, people don't realize that capital gain income, that you can have close to $33,000 per individual of capital gain income and pay zero taxes.
Depending on your tax bracket, yep.
Exactly.
Yeah, and even if you're in the highest tax bracket, it's a lot less expensive. Capital gain tax is much lower, significantly lower than the ordinary income tax rate.
Right now, because of the virus and the volatility of the market, people talk about that we have a new environment, but there are going to be some types of stocks that may not recover before the end of the year. What should people be doing at the end of the year from a tax loss harvesting point of view, or from a tax point of view, for their portfolio?
I would not wait until the end of the year. If you can use capital losses for tax purposes, so most people are restricted to a $3,000 deduction for a capital loss, but if you have capital gain or other types of investment income that you can offset with capital losses, let's say you're going to sell a property, a piece of real estate, and trigger a capital gain, you can offset that with capital losses from your investment portfolio. And the way to do that is what we call tax loss harvesting. So you sell a particular investment, you buy another one that's very similar but slightly different, and then after 30 days, you have to wait to the 31st day, you reverse that trade. So for book purposes, you've triggered a capital loss, but in reality, you stayed invested. Yeah. And so if the market comes back up, you can stay in that second investment, but you still harvested a loss.
I'm a simple country boy, okay? So I have my money in my IRA. Why do I care about this? Because it's not okay. And that's why I wanted to point out to people, because we talk about this, and this is extremely important in your personal investment account. From an IRA standpoint, 401k investment, other kinds of investment, these are interesting, nice to know, doesn't affect me. So if the majority of my investments are in a tax deferred, because we get taxed later, those don't matter to me.
You are absolutely right.
Okay, thank you.
Right, thanks for pointing that out.
Yeah.
But the other thing too, I think that's really important is that most individuals, when they think of a financial advisor, is just about the investments. Here's an example of a tax loss harvesting that could save somebody major dollars.
Oh, this is what we've been doing the last 2 months.
If you don't, if you as a client, if your client doesn't communicate with you and to let them know what they're doing and what else they own, they're missing out on the value that you can provide to them.
Yeah. Yeah, particularly if you're going to sell a piece of property. I mean, the tax laws around that are so complicated that it really pays to at least have your CPA or, a financial planner, somebody with some tax acumen, take a look at it before you do that. A lot of times people get tax bills they just weren't expecting.
It's not just finding a good investment.
Yeah, that's true. It's all wrapped in, like the Ford v Ferrari, right? It's the brakes, it's the steering, it's the everything. Yeah.
And by the way, we're going to go into the tax-free and taxable in the bond area when we do the bonds.
Yeah. I'm not going to get into that today. So here's where we come to a really critical part of investing. And this is something you can control. We cannot control the market. We can't do it. We expect it to behave badly, and we build portfolios to anticipate that. But we also expect it to behave well at certain times. So you cannot. It's like a kid that's acting out. You have to ignore it. And so, but there are things you can do to take advantage of, you know, we call it making lemonade out of lemons when the markets go down. But if you just knee-jerk react when markets are down like they have been, then you're going to hurt yourself badly over time. So if you invest, and the tendency for most investors is to kind of, we call it recency. If the market has been doing well, it attracts more and more money. So people tend to think, oh, market's safe now, it's up, I'm gonna buy. And then when it starts to go down, you know, even very sophisticated investors, it's hard to stay put. So as an advisor, I think this is one of the greatest value adds that we provide, is to keep our clients in their seat and keep them invested during these difficult periods of time.
Or prevent them from doing something silly, like buying an indexed annuity, or buying a timeshare, or giving their money all the way to their children, or, you know, it's, we do a lot of silly things, and having somebody that you trust, that you can bounce money decisions or financial decisions that you're about to make before you make them, it just is, I mean, it's worth its weight in gold to be able to do that.
I think what's so rewarding to me about this job is that when clients call, I listen to their concerns, and I try to understand what, you know, whether there's anything they can do to control their fear or their concern about what's going to happen. And if there's something we can do, then we recommend that. But I think just being here to listen and understand what their situation is, and then we never tell our clients what to do, but we give them options and say, you know, what we found is that clients who behave in this way are more successful than clients who might behave in this other way. So it's just information.
Yeah, and if it's not your money, you're less emotional about your own money.
Yeah, although I have money in the market too, and I am not happy. But I don't have anyone to call.
You try to keep a discipline, you know, you got to have a plan.
I just tell my husband about it. He's so
There
tired
you
of hearing
go.
about the market. Every morning I'm like, what's the market doing today?
Why is this chart important, Gina? Why is this chart important?
This is important because this will show you the annualized compound rates of return for a portfolio, where in each example, so over a total period of time from 1990 to 2019, almost 30 years, that if you just stayed invested in the market and didn't do anything, we're talking here about the market as the S&P 500. If you just kept your S&P 500 index fund in place and didn't do anything over that period of time, it would have grown from $1,000 to $17,273. If you missed just the one best day in the market, that number drops down to a little over 15,000. You missed the 5 best days, drops down to 11,000. If you missed the 15 best days, even further, drops in half. And then, you know, so the trend is obvious, but what we find is that most folks, in an effort to try and time the market, moving in and out, you know, think I'm going to get out before it hits the bottom, then I'm going to get in before it hits the top again. They usually hurt themselves by missing, because these returns come in very concentrated spurts. There used to be a fountain at Fashion Island that, I don't know if you guys remember it, it's not there anymore. And the kids loved it because it was these little spurts of water that would come up, and the kids would all run around. It was all random. You didn't know which one was going to come next. And the market's the same way. We have no idea where it's going to come up next, but it happens quickly. And if you're not there to capture it, it's gone.
So if I put money into an S&P 500 indexed fund, you're telling me I would average 9.96 over the last 30 years?
That's correct.
Yeah.
Thank you.
Not
Just
doing anything.
Put
is
it in
your
there
best
and let it ride.
strategy.
Yep.
Yeah. And by the way, market timing and getting you to change your portfolio is a multi-billion-dollar business. They want you to make changes. So when you go to these free seminars and dinner presentations, they're going to make everything sound horrible, and they have the answer for you to make the change. And you're much better off if you bought the S&P 500, put that statements into your desk, never open the envelope, and look at it 30 years later and look what you got, because you didn't make any changes. So there is even a better way, because the S&P 500 is volatile, and not all of us have another 30 years, and all of our situations are different. But this chart really shows that there isn't one individual in this world who can time the market accurately over a period of time. There's not one scholastic study out there.
Yeah, the active investors nearly, when we call an active investor, to me means someone who's trying to time the market, trying to move in and out and avoid the downturns, or someone who thinks they've found a bargain stock and they're trying to pick a stock that's mispriced.
So we had an interesting question that came up. This is okay. So you missed the high day, 1 high day, 2, 5 day, whatever. What if you managed to miss the low day?
Good question.
If you missed the low day, well, I think in an effort to miss the low day, you also miss the high day. That's the problem.
Well, but then you're saying if I miss the high day, I also miss the low day?
Well,
Most likely.
yeah.
I mean, if you're out of the market because you're trying to miss the low day, which is what people are doing on average. And I think this next chart will answer that question. So if you get the problem with trying to do that, so I want to miss the low day, I'm going to get out of the market. Now I have to time the market twice in order for this strategy to work. I have to get out before it goes down, and I have to get back in before it goes up. So what we know is that the market recovers pretty quickly after any major crisis, after any major drop in value. So this chart shows us, you know, going back to October 1987, these various crises, what happens after 1 year, after 3 years, and after 5 years. And you can see that in all cases, after 3 years at the worst, the market came back up and exceeded earlier valuations. And after 5 years, it was rocking.
By the way, if it is normal for the market to go up and down. So,
yes. Yeah.
so if you think that the market is just going to go steadily increase, then you need to be in CDs or in a 20/80 asset allocation portfolio. But volatility is normal. The question becomes, how much volatility can you as an individual mentally and financially take? What is your risk tolerance? What is that sweet spot for your personal portfolio?
Yep, absolutely right. So just to beat this one to death, if we look at average annual returns after a big market decline, one more than 10%, which is what we call, technically that's called a correction, if it's more than 10% decline, since 1926, so this includes the Great Depression. And even with that horrible period of time, and World War II's in here, and you know, all kinds of other terrible things, 9/11 and dot-com crash, and just another way of showing you what we looked at on the previous slide, which is that within 5 years, we're looking at a 9.6% average annual return. So on that slide I showed you earlier, where it was down to 5% for a 100% equity portfolio, guarantee you within 5, I don't guarantee anything, but I would expect that within 5 years, that number would be back up to at least 9 to 10%.
So when you're doing a financial plan and doing some projections for individuals, Gina, and you're using a moderate portfolio, what percentage return are you using in the plan for a moderate?
Moderate to us would be either, I would think like 60% in stocks, 40% in bonds, or maybe 50-50.
Yeah. So what kind of a return are you expecting in the next 5 years?
We've adjusted all our return expectations lower just to be conservative.
And
Because
what are those?
I would say probably in line with what we saw the March 31st.
5 to 7%.
I would say for a 60-40 portfolio in that range.
Okay.
Yeah.
And that's taking a moderate risk. So, which if you're just in CDs today, what are you getting?
Oh my gosh.
You know?
Hardly anything.
Yeah.
Well, the 10-month Treasury is paying 0.6%.
So
0.6% per year.
So taking a moderate risk to get a 5 to 7% return over a 5-year period sounds pretty reasonable.
It does. And, remember again that even after the Great Depression, within 5 years of the bottom of that, thank you, Don, it had come rocketing back.
So let's look at the next slide.
So here's the question I get. So, well, what do we do once we've picked our portfolio? What should we be doing? So obviously, as an advisor, we're doing a lot of things. We're doing that tax loss harvesting. We're always, benchmarking the individual mutual funds we've selected. But as an individual investor, I think you only want to adjust your allocation if your goals have changed or if your needs have changed. Otherwise, you're just going to adjust it to rebalance. So over time, if you're in a more aggressive, not more aggressive, but a moderate portfolio, 60-40, if you had bought that in 1997, by 2017, your stocks would have gone up to 56% of your portfolio. So you would need to sell some stocks and buy some bonds. In conclusion,
back up one for me, if you would. So one of the interesting parts to me with the rebalancing issue is you can look at this and say, okay, well, but you're telling me I'm going to sell my good stocks and go out and buy bonds that don't do as well to get myself back in balance.
Correct.
Okay. One of the interesting parts is when you have to take your required minimum distribution, one of the things you can work with an advisor on is when you're going to give me the money, use that to rebalance. Because take out the money that, all right, you had good profit on those stocks. Let's take that money out so that you then reduce the amount of stock. So when you pay me my money, take it out whatever's over allocated.
Exactly. Yeah. And anytime there's money coming in or going out of a portfolio, it makes sense, to be allocating. But if you're, especially if you're taking required minimum distributions, you don't want to be this heavily into stocks.
Is there a limit to the number of telephone calls or meetings that a client can have with you, Gina?
No.
No, it's a.
I mean, it runs the gamut. And that's one thing we document when people come on board is, how often do you want us to contact you? How often do you want to meet? How do you prefer to be contacted? Do you want us to text you? Do you, what works for you?
Yeah, it's not like a broker situation where you only call your broker when you want to make a trade. This is an ongoing relationship, and that financial plan after the first year, you kind of see where you are and how did it work out, and we'll adjust it again in the second year. It's a very close relationship that you have with your clients.
It is, yeah. Yep. Talk to all of them on their birthdays. So I think just a couple more little slides here. I think this is a very comforting slide in that you can see even the Great Depression back in the 20s and the 30s, we survived that. And, we have so many more tools in our basket now to use against these financial crises like we're dealing with right now, that I really don't expect this to last as long as many people are saying it's going to, but hopefully I'm right. But in general, you can see, you know, when people ask me where are stocks headed, I say up. I mean, it's just a question of the time frame that you're looking at. So I think this gives me personally a lot of confidence in how great the US stock markets and the world stock markets are.
Isn't it a reflection that capitalism is growing in the world?
Right. Yeah. I mean,
it's literally in almost every country, capitalism works. And therefore, it's right now, for example, in China, you know, washer dryers are some of the biggest products that are being sold.
Yeah.
And it's not here in the U.S. that most of them are being sold. So people think, how high can this market go? Well, there is no, maybe in another 100 years there's a limit, but I don't see anything in the near future.
No, I think it's wise to expect the trend to continue. Just to wrap up, just want to emphasize the point that accepting market returns for what they are and not trying to outperform the market, which is what so many investment advisors sell these days, is we can do better than the market. If all you get are the returns of the market here, you're going to do just fine. So don't be greedy. Don't, you know, get sucked in by that kind of a pitch from anyone. And appreciate everyone's time. Do we have any more questions?
Don, you're the...
Sorry, I had muted and made myself invisible. No, there are no additional questions.
Great. All right.
Yeah, so what we're going to be doing is next week, we'll go into medical care planning.
Gina, do you want to unshare?
Sure. Yeah, let me do that.
Thank you. There you go.
So next week, we're going to go into medical care planning, because medical issues, long-term care, could be a major hit.
Please keep yourself out. No cameras, please. Thank you.
Thanks, Joanne.
I'll turn it off in just a minute. As soon as Pete wraps up here, I'll turn off the camera, and then I'm recording, and we can do whatever we want. So.
The reason why we have medical care planning is because long-term care costs are so expensive, and you need to plan for that. Medical care is very, very important. And then following that, we'll go through stocks and bonds in more detail. So, Gina, fantastic. Love
Thank you very much.
Thank you
very
so much.
Okay.